Life after QE. The central banks begin on what could be a long path of potentially very painful tightening. Where is the best place to be and the best places to avoid in the market? Sean Corrigan joins us now from Cantillon Consulting. As we go through this period where banks start to tighten, we've not seen the evidence too much yet of any QT. Of course, the US has got this program of beginning at 10 billion a month, very small compared to the big picture. But is QT going to be a seminal moment?
I think we have to differentiate between what the market can make of it, and markets are often irrational, they're sentiment driven, they're full of non-linearities and pitfalls and time bombs, and what the mechanics are. 10 billion a month, as we're going to start with from the Fed, is a rounding error. I mean, the American market is huge. The American government itself has borrowed an extra couple of $100 billion this year from the year before because the budget deficit's expanded. We issued about $580 billion a month in all sorts of securities in the States over the summer. So 10 billion is a small fraction. The point is, does this 10 billion get everyone so worried that it's going to mean something that they make it mean something? So that's a slightly different issue. There is still a risk involved with that, yes.
And they're raising interest rates at the same time. So this tightening is coming from two different directions, albeit just a sentiment, perhaps maybe that 10 billion a month. Europe is potentially looking at tapering its bond, well, we know that already, the bond program. Got rates rising here in the UK, heat beginning to be generated in the Japanese economy. Can the global economy continue to operate knowing that interest rates are beginning to get, or the liquidity is beginning to dry up?
Well, it depends on how the world economy is integrated with the program. We know that they're going to pussyfoot the program. We also know, particularly in the case of the ECB, that they haven't really agreed to cut it. That's a bit of a fiction. Mario Draghi obviously had to give some concessions at the last meeting, but there's all the usual caveats about if things turn out differently, they'll continue or they'll do whatever they need to do. Japan clearly hasn't come anywhere near a finishing at the moment. So yes, the situation is not the one-way street it was. But it's not necessarily gone into reverse yet. If the world economy is going and growing and there are prospects for more earnings, more employment, there's more need for capital, then interest rates naturally should rise. If there's more demand for credit to build useful things, then the demand should pull the decision making into that link. So interest rates rising of themselves is not a bad thing. In fact, it's a good thing if they do respond. If capital is in greater demand and you subsidize it, then too many people borrow for the wrong reasons. But could this be an issue because we are so over-reliant on central banks, because we've all traded in this position, and because us in financial markets have pushed things into a box? That's always a problem, always a potential problem.
What about emerging markets? How are they going to cope with tightening? And I think you mentioned in your most recent piece about the bond spreads are showing a positioning which we haven't seen since the last crisis. And I think you measure it against previous crises for emerging markets. And you say out of what came out of the situation that's developing now is another crisis.
Well, yeah, again, I mean, people have focused on junk bonds in the States in the last week because we had a bit of a nasty sell-off at the end of it. But
junk bonds are these bonds that pay high levels of interest.
Yeah, so they're less credit-worthy corporate borrowers, and therefore that they usually have several percentage points of extra yield attached to them over and above the basic Treasury benchmark because they're more risky. Mm-hmm. They've attracted a lot of attention, but if you look at emerging market bonds, similar things have happened, and for similar reasons, because the global flood of liquidity has forced borrowers to move out the credit spectrum, as we say in markets, in other words, to take more risk because they've got to earn a return somewhere. And while things are going well, this is okay because you get a double benefit. You not only get a slight yield increase over the really safe stuff at home, but of course you drive the yields on those bonds down, you drive their prices up, so you look like a genius. So when it's working, it's great. But the problem is with emerging markets and with the high yield bonds in the States, they're very cyclical. And when things go wrong, they go wrong very quickly and very badly. And the levels that we have now in the emerging market universe are so low, they're at the levels that we saw just before subprime, just before the Asian contagion in the mid-90s, and the tequila crisis a little earlier than that. So it's not to say history has to repeat itself, but we seem to be in an area where we're making it, we in the West and the Japanese and whoever else are printing money are making it far too easy for people there to borrow money. So there's a risk both sides on that.
So you're not raising a red flag, you're just pointing out the fact that we are at levels which are beginning to look a little worrying.
Well, they've also got to the point where they've stalled out, so they're not now really showing much extra. Not only is the yield not that as high as it was over the safe one, so you're not getting paid day to day as much as you were to run the risk, but also you're not driving the yields down lower, so you're not getting that capital gain in the background. So the overall return from these things is now as low compared to the safe stuff as it has been. So there's no real extra juice in this. So what you have to worry about, the two sides to it. Are the people in emerging markets taking this easy credit and putting it into projects which shouldn't be built, won't pay a return, won't pay the debt back? That's the first side, they get it wrong. The second one is we're doing it because we're chasing in and following a momentum trade, and at some point we have a shock which could be in a completely unrelated area, and as we try to pull it out we find these markets are nowhere near as liquid as we thought they were. Nobody wants to take the stuff off our hands, and we have a horrible game of pass the parcel, and then that has real economic ramifications. Now this is what's happened in the past in one form or another. It's not a prediction that this is going to happen next week or next month, but the longer we're down here, the longer we run the risks of something like this recurring.
And we know that the markets are taking on risk at the moment because the volatility is very low, isn't it? The VIX index is showing very low. What does that mean exactly, and how should we interpret that?
Well, again, this is a thing so the volatility index is slightly complicated. It's how much things have been moving in the recent past, and what we think is going to happen gives us a prediction for our average change in price. It's a statistical calculation, but it's kind of a bet, how much will it move? And when the bet is very low, we don't think it's going to move very much indeed. Again, this is something that of itself doesn't necessarily mean anything, but traditionally if we look at 30 odd years of data, which we now have for stocks and for bonds in America, we're way off the bottom end of the chart in what we're pricing. We tend to price something in the high teens, so in a year we tend to think the American stock market should move about 15% up or down. Now we're pricing in single digits, and it's never been seen before. We're doing the same thing in the bond market. So again, total complacency, no protection being taken really against the risks of something going wrong.
Okay, let's set out a possible scenario then about things do go wrong. Where is the keen money then going to go? Where does capital go? Where do the trades go that provide the profit?
Well, the standard thing is the flight to quality. So you go back to the riskless bonds, and you go back to the so-called riskless bonds, the government bonds, and you go back to them in the bigger economies. So of course that means treasuries, bonds, gilts. We leave those to one side for the moment. Possibly Japanese bonds. So that's always the thing that happens. There's a second layer to this, of course, is because we know the central banks are so tentative about withdrawing their stimulus, we kind of all think in the background, and this is partly the feedback loop is why all these volatility measures and spreads are where they are, is because we assume that once there's a sign they go wrong, the central banks will immediately backpedal. They won't want to make the mistake of, won't want to be accused later of having tightened too insensitively and caused another downturn. So we all expect them to backpedal. We know the Bank of England will. I mean, it's practically told us. We know the European Central Bank will. The Japanese won't even stop. And we even know the Fed in the background. There are voices within and around the policy-making apparatus, which is what we're going to keep. We'll nudge it. We'll nudge it. But the minute we think it's wrong, don't worry. We're not going any further. So that in itself shows you that when we get this reaction, we'll flood back to the treasury bonds and the bonds and the like, and we'll try and leave the riskier assets behind.
And when markets start to absorb more money in those familiar markets like the treasury market, the dollar goes up, doesn't it? And when it's bunched, the euro will go up, presumably.
Well, we tend to find that in panic situations, because everybody is borrowed in dollars and leveraged in dollars, that gets a bid because there's less credit available, particularly for the speculative positions. We also tend to find the Japanese go bid. So it would be the yen and the dollar, and the question between those two is slightly moot, but they would tend to outperform the other currencies, and certainly the lesser currencies.
And equities, we have to ask about equities. I know it's not your field necessarily, but presumably that would be the downturn that people are then...
In that circumstance, equities are unlikely to continue to stay strong. I mean, we've seemed to have run out a little bit of momentum. It's year end, so we have to be a bit careful about drawing too many conclusions. But we've been a bit sideways for 6, 8, 9 weeks now, and people are therefore beginning to find excuses as to why we're not going any higher. So the next stage is, let's find an excuse for why we should go lower. So let's see how year end pans out before we get too categorical on this. But that could be a case that we're due some sort of correction, whether it's a major economic downturn at this stage, but maybe we're running out of oxygen on the upside for now.
Yeah. Okay. Look, it's a pleasure. Thanks for discussing that with us, Sean. Sean Corrigan there is from Cantillon Consulting, taking a big picture look at some of the maybes in the markets.